Hello, and welcome back to our gross income problem set. This is problem number 7. Grapefruit receives the following items from her employer, Big Apple Corporation, which is a large bank during the year. So the first item, and we're dealing with gross income here. So remember, we're dealing with income tax. Any type of income tax question, we have 5 questions to worry about. First, do we have what amount of gross income do we have, if any? Second, what amount of deduction or credit do we have? So the first 2 questions deal with inflows and outflows. Third, when do we have those items? Who has those items? And what's the character of those items? Now again, we're focusing on gross income inflows. So really, we're focusing on what amount of gross income, if any. When do we have the gross income? And who? So the definition of gross income for tax law starts in Code Section 61 and says all income from whatever source derived. Very broad language. And there's not really a specific thing that says, okay, well, what is the guidelines for gross income? So for that, we go to the Supreme Court case, Glenshaw Glass. And in Glenshaw Glass, there's 3 elements. There has to be an accession to wealth, which means net worth, which is assets minus liabilities, have gone up, which that must be clearly realized. There must be a realization event, which means there's a severable event, a legally severable event. And finally, there must be complete dominion and control by the taxpayer, which deals with, are there any strings attached to the amount? So if we go through and we have salary. Salary is a pretty clear-cut example because when you're looking at your net worth, you're looking at the tax year. The beginning of the year, Grapefruit is an individual. Beginning of the year, Grapefruit doesn't have the salary. End of the year does. Assets have gone up. So that's met. Realization. Remember that with services, which Grapefruit's performing services for the company as an employee, realization is always met because it's severable. The salary is severable from the actual services creating it. And finally, are there any restrictions on the salary? Nothing we're told. Nothing we're told. So that is dominion and control is met. Dominion and control is met. So therefore, the $100,000 salary is included in gross income during the year by Grapefruit. All right, so the next item is $50,000 as a borrowed loan pursuant to a home equity line of credit. So this is a bank, a large bank, and they do loan money, and they're loaning money to one of their employees, Grapefruit. So the question becomes, going through Glenshaw Glass again, GG, right? Do we have net worth increase? Does our net worth go up? Well, when Grapefruit gets the $50,000 cash from the loan, yes, assets go up. But what about liabilities? Liabilities also go up. A loan is a liability. Loan is what's owed to creditors and whatnot. So assets go up by $50,000. Liabilities go up by $50,000. If you're looking at our formula, an increase in $50,000 of assets minus an increase of $50,000 in liabilities equals 0. So actually there's no net change. No change. So if there's no change, that means that net worth has not gone up. So therefore, net worth is not met, and therefore, we do not have gross income when we have a loan. So this is the principle of why loans are not considered gross income. Now, do we have realization and severance for, realization, severance, and dominion control? Generally speaking, we do because of the events taking place. But again, net worth is what's the issue. So this is not gross income. Not gross income to Grapefruit for the year. So it's there's a difference between calling gross income excluded and just saying it's not gross income. This is not gross income. So when you don't meet the Glenshaw Glass definition of gross income, it's not gross income. Versus if you meet the Glenshaw Glass definition, but Congress says, no, we don't want it to be gross income, then it's called excluded. So that's important to understand, not gross income versus excluded. So when you're talking about the lingo with respect to gross income, there is included, which means it actually goes on the tax return. There's not gross income, which means that the Glenn-Shawglass Supreme Court definition is not met. And then finally, if you meet the Glenn-Shawglass definition, you have gross income under the definition, but it can be excluded. For example, we'll talk about later on in later videos, municipal bond interest is excluded from gross income. But interest, any interest that you get meets the Glenn-Shawglass definition, whether it's tax-exempt interest or from a corporate taxable interest. Makes no difference. It's all gross income in the definition, but Congress says, well, it's excluded, so therefore it's excluded because we want, for social policy, we want to do so. All right, so the final thing is a $50,000 advance of half of next year's salary received on December 1st so Grapefruit can pay off a family member's medical bills. All right. So again, we go through our Glenn-Shawglass definition. And we're looking at net worth, realization, and dominion and control. So the first item, net worth, our assets have gone up. We're looking at year one here. By the way, for this question, we're saying during the year, so year one, not year two. So the idea here is that Grapefruit's getting a $50,000 advance of half of next year for year two. But Grapefruit's getting that amount in year one because Grapefruit needs it to pay off some medical bills that a family member had during the first year, this year. So assets go up because Grapefruit gets the cash. However, you could argue, and this is argument, is there a liability with respect to having to perform the services for the future? So that the question becomes, okay, when we're looking at our net worth going up, do we have a liability increase? Do we have a liability increase because of what's going on with respect to the Grapefruit having to perform the services? So if for those of you out there that have taken an accounting class, this can be viewed similar to the liability of unearned revenue, which is where you receive a prepayment by a payment in advance, but you haven't yet performed the services. So this is like unearned revenue. So obviously when you're looking at net worth, assets have gone up here, right? Grapefruit's assets go up by $50,000, but have liabilities gone up by $50,000? If you take this unearned revenue approach view, then yes, they do. So some of you are saying, okay, well, this is not net worth. Well, again, the tax law has its own definition of gross income. Now, before we I explain this, I just want to clarify again what the issue is. So what we're saying is, in situation one, we have situation one and situation two. Situation one, it's clear it's net worth. There's no possibility to say there's a liability. So we're on this end of the spectrum. Situation two, we have a loan. So number one is gross income or is net worth because your liabilities don't go up. Situation two, which is a loan, net worth stays the same because it's definitely a liability. You definitely have to pay back the money. Well, this situation has elements of both. We're getting the cash in advance, right? Because if Grapefruit performed those services next year, there would be no loan to pay off, right? So it would be definitely gross income situation number one, the first one, the $100,000 salary, and that would be included. But if this was a loan, if instead of doing this as an advance of salary, the employer said, well, let's just loan you $50,000 so you can pay off your medical bills, it'd be obvious that would not be a net worth increase because Grapefruit have to pay it. Well, so we're somewhere in here, we're trying to figure out which one is it more similar to. So the law, there's various cases out there that deal with this situation. They've kind of addressed this specific situation. And really what they do is they focus on a few things. But it's actually, from the case law, viewed a little bit closer to the first situation. You might be saying, well, it's definitely, it's liability going up because they still have to perform the services. Well, the idea here is, the question becomes, what if the taxpayer, Grapefruit, actually had to, or what if the taxpayer ended up quitting or got fired and got this $50,000 advance? Well, what would happen? Well, the employer, Big Apple Corporation, could come after Grapefruit for the money because Grapefruit did not perform the services. The same idea, again, with the unearned revenue concept in accounting, which again is where if you're a service provider and you are a good provider and you've gotten money in advance, like you have your magazine's company, and you get magazine subscriptions, and you got all this money in advance for the year, but you have to perform, you have to send out Sports Illustrated for the rest of the year. That's an example of unearned revenue. Well, if you don't perform, then they can come after you. So if Grapefruit does not perform the services, then the employer can come after them. However, based on our timing definition rules, which timing means our when question, actually the case law says that the $50,000 must be included. It must be accelerated. And the reason is because there could be some games that could be played here. This could happen all the time. And you could get the money in advance and play games with for tax reasons. So this would be gross income, or it would be net worth to Grapefruit. So this is a special rule. It's from the case law, and it really comes from the timing rules, the more of a timing concept, because you're going to see that when it comes to timing, when you get things like prepaid interest or prepayments like this, almost always it's going to be included. Another reason for this is Grapefruit is likely a cash method taxpayer. And cash method taxpayers have to include that a portion because, again, the idea here is that Grapefruit would have had to include that when the services would be provided. So therefore, it makes more sense to view it in the year that the actual cash is received, not when it's accrued. So the $50,000 is net worth, even though, again, there's a liability issue there. Again, the idea is that you're somewhere between this continuum, but the case law says it's closer to the first situation, the pure salary, not the pure loan. We do have realization because of the services. It's a service element. And finally, are there any restrictions? Well, you could make this into an example where there are restrictions. How could you do that? What if the amount was paid directly to the medical bills? Well, there would be restrictions on that, but it still would probably be argued that it would be income. So there is no restrictions on this amount. Technically, Grapefruit could take that money and do whatever he or she sees fit. Yes, it's on the premise that Grapefruit will pay off the medical bills, but there's nothing specifically saying like, oh, it was paid directly to the hospital or whatnot. So dominion control is met. So therefore, this is gross income to Grapefruit during the year. So it is included. It meets this test. Gross income to Grapefruit of the $50,000. So if we're going through our three examples, salary is definitely gross income, so $100,000 included. Loan, a pure loan, is not gross income because it's not net worth. And finally, we're in the middle because we have this performance element like unearned revenue for this employee. And again, the case law has come in and said, yes, it is net worth, it is gross income in the year it's received. So in year 2, when the actual service is performed, you don't have to record it. You have to record this half in year 1. So it's more of a timing issue. It's definitely going to be recorded, but when is it going to be recorded? Versus when this loan is paid off, it's never going to be recorded because it's not any type of actual net worth going up. Versus when you view the year 1 and year 2, for this aspect, net worth will go up over time in total. So that's really the way to think about that, is that in this example, it is closer to the pure salary because, again, and when you look at over the 2 years, it would be salary anyways. It's, again, just a question of do we do it in year 1 or year 2? And, again, the case law said it's in year 1. So we have $100,000 salary plus $50,000 of advanced salary means that Grapefruit has $150,000 total of gross income from these 3 issues.